And there's a lot of things you can do there, particularly if you're looking at larger properties. It may be economical to actually have somebody come in and take a look at what your taxes will look like. You can actually get tax consultants, and they'll give you a much stronger idea. Also, it depends on what market you're in, like Northern Florida. Bo Berry will tell you, your taxes in this county are likely to be X percent of your purchase price, the assessed value. So you can get a great idea. So wherever your market is, you've got to find a pulse on that, and then yes, get your quotes early. Insurance as well, particularly in Texas and Florida. I know I've been in Florida before it was such an issue, and but there you go. We planned for all kinds of things, but Florida's insurance market getting even worse? No, I thought we were already there.
Yeah, and you add to that, like when these things were going on a couple of years back, we were fortunate. I'll talk about a strategy here in a second. We got out of most of our multifamily stuff in 2021, 2022, like before everything kind of really hit. I mean, we thought it was high in 2020, right? And I felt like it was a perfect storm. Looking back, it's more like hindsight's 2020. We didn't get out of everything. We're working through some capital calls, and we're getting some stuff it's hurting. But you had this bonus depreciation, right? I call that tax flow. It was 100% for multiple years, and it started to go down here, 80, 60, 40, right? And now it's back to 100. But you got to ask yourself, is bonus depreciation disproportionately increasing the value of this property, right? When you're making offers. Welcome to the Build to Billions podcast, where we guide successful entrepreneurs and investors on their journey from millions to billions. We believe the key to scaling and compounding your wealth and life starts every single day with a mindset and practice of stewardship over ownership and applying billionaire biblical principles. Our ultimate goal is to help you scale and compound your wealth and life so you can give more all of it away to help MVPs. My name is Brett Swartz. Each and every episode, we're joined by the world's top entrepreneurs, millionaires, or billionaires, and they share their secrets, wisdom, and insights with us so we can all level up and make a bigger impact. I'm excited about our next guest. He's out of the Michigan area. He's the author of Passionate Living Through Passive Investing, and he's going to help us build passive income in real estate without the tenants, termites, and tantrums. And he's got a really kind of a tremendous background that he's going to be sharing with us. He's an award-winning data scientist. He's on the Who's Who for 2024. He's a cited bioscientist, heavily cited bioscientist, and he currently is an active investor in over 550 units across the United States and a passive investor over 700 units. Please welcome to the show with me, Mr. George Roberts. George, how are we doing?
Doing well, Brett. Thank you, and great to be on the show.
Excellent. Yep, grateful to have you. And for our listeners to get to know you for the first time, would you give us a little bit more about your story and your current focus?
Yeah, absolutely. So I came from a tech background. Went into real estate when I realized it was just absolutely the best place to put my money. And nowadays I do invest in apartments, love it, invest actively and passively, and love to help other people do the same.
Beautiful. And superpowers growing up for George, what was the two super strengths that you always just kind of had, or the things that help you to help bless people, help you to help bless people today?
Well, I would say enthusiasm and curiosity, and that's really what carried me through my scientific career, and it's what takes me through to today, and also obviously part of my book as well, which is all about my life, not just investing.
Awesome, love it. And so let's dive right into the topic, which is kind of the name of your book and the podcast, Passionate Living Through Passive Investing. What does that mean to you, and how does that help people today?
Yeah, so it's all about living today and enjoying your wealth, not just about accumulating poker chips. So the most important thing I think people need to do is wherever you're at in your finances, make sure that you have some economical ways that you're enjoying your life every day. So it shouldn't all just be about having a 2-week vacation at the end of the year, or if you're an entrepreneur, maybe not even 2 weeks. So remember, that it actually may be harder as we get full control of our schedule. We have to seize control, use that control, and the rest of the book, the passive investing part, is just about my passion for helping other people learn how to invest in private markets. You can't outrun the pack if you run with the pack. So we have to look places other people are not looking. So look in private equity, private debt. These are some great things to do. And then I also bring in a lot of mindset in the book.
Excellent. And yeah, I couldn't agree with you more. I feel like most people, they read the Rich Dad Poor Dad book, right? And they want to get to that fourth quadrant, but they never do, right? They get stuck in 2 and 3, and this idea of if I only, if I only had this many more X, then I would be truly passive, right? And so if you don't, I'm curious, what's helped you to get, I call it truly passive income, where I call it no shoes, no shirt, no problem. You're Kenny Chesney on the beach playing it with a guitar, and the money's consistently showing up. It's durable.
Right.
You understand the investments, and it's it's $20, $30, $40, $50,000 a month, whatever that number is. But you're not trading into the time. Yeah, I like how you put it. The termites, the tantrums, right? The tenants.
Yeah.
You are able to live, your life, right? So what's when you hear truly passive income, what does that mean to you?
Right. So I think there's two sides to it. To get that truly passive income, you have to look for your margin of safety in every investment. Make sure that however cautious you think you need to be, probably 10x, continuous learning, because you never know enough to be an investor because the game is always changing. That's the one side of things. But then the other is just avoiding the lifestyle creep. So the no shoes, no shirt, no problem. For me, that's being out of my sailboat, and I got my sailboat for $5,000. Okay, I could have gone for a yacht. I could have afforded it, and it would have been great. But guess what? Then I have new problem, right? And so the most important thing I think is that no matter how successful you are, you just have to be happy with what you've got, because if you don't, again, you're just going to be buying a bigger problem every time you get a new desire in your life.
That's really good. I like that. So margin of safety in every investment, continuous learning, avoid lifestyle creep, and learn the secret of contentment, right? With where you're at. I think is what you're saying so far. So let's keep going here on due diligence. When you're the margin of safety of an investment, like how do you look at due diligence? What's your approach? What's your system to it?
Right. I mean, I would say starting with when you're just going through your financial due diligence, etc. The first thing that I look for is the rent roll, because everybody says, "Hey, we've got below market rents," and I look at it, and it's, everybody moved in the last 2 or 3 years, and you have 96% occupancy. I don't believe it. Take a step back. I do get a lot of deals from newer investors. That's something I'm open to, and so I really want to help these people, and so I would say, just take a look at that rent roll. I mean, you see a whole bunch of people that are month to month. You see people that have been there 5, 6, 7 years. These are some things that help to tell me that, yeah, maybe we really do have some below market rents, getting extraordinarily good comps. This is something that I find almost nobody does, or if they do, they're just not sharing it, because their comps look just as bad as the ones that I see in the OM, and they seem more aspirational rather than reality based. So go out and get those great comps, and whatever you're showing in your OM, make sure that you have 2 or 3 rock solid comps built around the same time, same quality of construction, similar amenities, or at least that you're tracking the differences. And again, those are a lot of things that I really don't see people doing. So I think that's really where it begins. And with due diligence, I don't know that there's a whole lot that I have to say about that that's going to be different from other people, but some obvious things. Make sure you walk every unit. I video every unit. You have to check everything, including do you have the proper zoning, etc. Some of these things are really easy to check. Or floodplain. That's something you can check even before you get into this. What's the insurance going to look like, etc. So leave no stone unturned. If you've never done it before, obviously work with a very experienced partner. Make sure you're working off a checklist, because again, it's just so much easier to work maybe say 20% harder during due diligence than to try and fix something later on.
Yeah, I couldn't agree with you more. I also would add, rubs, right? Because someone might be quoting, $1,500 of rents, but they're also going to bill you back, ratio utility billing for utilities, another, $125 to $175, depending on the number of occupants and or, what it is. And or they're not doing that and it's individually metered. Most apartments are not, unless it's, individual hot water heaters. But these are only things that you can learn as you do, like you said, walk the units, right? And sit down with the manager and see these things in real time and get a sense for the cars that are parked out. Are there broken cars out front? Are people, a ton of stuff just like draped across their their balconies, right? And how's the maintenance in the yard look? I mean, someone might be able to take a picture of something that's in its perfect state and get all the lighting, but go there at nighttime, go there in the morning time. Like, are people working, right? like,
Yeah, that's
like,
another great one.
yeah.
Going there on the weekends is another thing. See how many characters are hanging out on the street corner.
Yep.
That'll give you an idea of what quality of environment you're dealing with.
Yeah, the schools, the local schools, with the school
Yep.
districts. Ask the people: are they going to local schools? Are they moving into those units because they want to go to a certain school, right? So understanding that you have to experience it. You just can't look at a data sheet. Although, yeah, I agree with you on the rent roll. That's key on the financials. And then finding out if you can actually shop the insurance, right? And of course, the interest rates that you're buying at and the property tax that's going to be reassessed based upon the new purchase price. There's so many things there that take the time. Anything else that you would add to the due diligence of multifamily or just in general for investments or sponsors?
Yeah, again, finding that margin of safety. I like to have below market rents going in for the same quality of units. That's the only way I have a true margin of safety because you don't know what's going to happen. Even if you have economic diversity, a factory closes down, and all of a sudden you go from great demographics to not so great. So, very, very important to know how much you can raise the rents immediately without any work. That way, who knows? What if we experience the quickest increase in interest rates we've ever seen in our country, and you don't actually get to refinance like you expected? So things will go wrong. You need to have a plan. As they say, planning is essential even when plans are useless. So if you haven't planned for 5 or 6 things that go wrong, when that 7th thing that you didn't expect go wrong, you don't want that to be the thing that sinks you.
I agree. What do you think about this? Most people have a cash flow mindset, but they don't have the tax flow or the debt flow mindset. And like you said, they take for granted that they think interest rates might be locked really low for a long time. And they get themselves in situations where, oh man, yeah, I can't count on double-digit returns on rents every year or continue to grow. Oh man, I can't count on debt to stay where it's at. And then now, it's sinking some of these ships with the multifamily world. I call it the year of the jujitsu tap out for owners who've been waiting, survive until 25 and now it's 26. And they're like, I can't. I'm like, my arm is going to break. I got to give it back to the bank, or I got to get a bunch of, capital calls. So what is your take when you hear cash flow, tax flow, and debt flow?
Yeah, absolutely. That's the way to look at it. You have to look at the cash flow first and foremost. People are looking for appreciation only. They got some major trouble. Another thing is you mentioned double-digit rent increases. Yeah, I love that. I want to say that the rent escalator, talking about inflation expectations, I feel like that's a last refuge of scoundrels because you can make just about anything work if you assume that you can inflate away your debt. You may, but and I love it too. Taxes, that's huge, and there's a lot of things you can do there, particularly if you're looking at larger properties. It may be economical to actually have somebody come in and take a look at what your taxes will look like. You can actually get tax consultants, and they'll give you a much stronger idea. Also, it depends on what market you're in, like Northern Florida. Bo Beery will tell you, your taxes in this county are likely to be X percent of your purchase price, the assessed value. So you can get a great idea. So wherever your market is, yeah, you gotta find a pulse on that. And then, yes, get your quotes early. Insurance as well, particularly in Texas and Florida. I know I've been in Florida before it was such an issue. And but there you go. We planned for all kinds of things, but Florida's insurance market getting even worse? No, I thought we were already there.
Yeah, and you add to that, like when these things were going on a couple of years back, we were fortunate. I'll talk about a strategy here in a second. We got out of most of our multifamily stuff in 2021, 2022, like before everything kind of really hit. I mean, we thought it was high in 2020, right? And I felt like it was a perfect storm. Looking back, it's more like hindsight's 2020. We didn't get out of everything. We're working through some capital calls and we're getting some stuff it's hurting. But you had this bonus depreciation, right? I call that tax flow. It was 100% for multiple years, and it started to go down here, 80, 60, 40, right? And now it's back to 100. But you got to ask yourself, is bonus depreciation disproportionately increasing the value of this property, right? When you're making offers? That's number one. Number two, low interest rates, debt flow. Is the low interest rate environment disproportionately increasing the value of the property, right? Those are two things. The other one that I think is for tax flow is cap gains tax and 1031s. Are sellers of large assets trading and deferring tax, is that disproportionately increasing the level of value? And when you have all of these hitting, plus, yeah, some markets were like, 3 to 5%. Some were like 8 or 9% multiple years. Some were, it was crazy. Or the rent growth, right? Just the rents. Mm-hmm. And it's like, okay.
I'd like to see some more of that again.
Oh yeah, we would. But my point is, it was so green. It was green, 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 green. And you're like, and you're like, whoa, this is kind of wild. Like, they paid what for that? And like, I just remember hearing over and over, oh, I thought $1 million or $2 million over what I thought it was worth, and someone paid another $3 million on top of that. I don't get how they made any money, right? And you're looking at it now.
And then we go back a few years and we see that they didn't. A lot of those in 2022, 2023. And even 2024, a lot of those deals obviously going bad.
Right.
Yeah, vintage is huge. So that having that timing, not getting into too many deals when things don't really make sense. And I certainly slowed down quite a bit myself. And it's that sort of caution. You have to live to fight another day.
Yes. And with that being said, I believe the best way, or well, I'm curious what you think. I'll say my thought, and then give me what you think. You got to find strategies that allow you to do cash flow, debt flow, and tax flow in a very time efficient manner. In other words, 1031 for so many reasons does not give you that advantage, because you have to sell in the same market that you're buying in, right? You are forced to buy within the time frame. Yeah. You're forced to replace the debt within the time frame, which is the one that gets missed the most. It's not just equal or greater value of the price, it's equal or greater value of the debt. And without that, you get hit with the tax, right? And so you've got to be aware of these things. And so to me, having a strategy that allows you to get out of debt, to get time on your side, to diversify, and then to come back at another date, that to me is the Netflix way of exiting versus the blockbuster 1031. But I'm curious, what do you think about the 1031 exchange and or these forced time frames that can be very restricting?
Well, I think you put it perfectly. Having to buy in the same time frame that you sell is huge. Those timelines are completely unforgiving, yeah, I think you hit it.
Yeah, the unforgiving timelines, right? I think it took, at least in 2008, real estate, which was mostly residential, took about 3 years to hit the bottom, right? Mm-hmm. So, maybe 3.5, right around that 2008 to 2011-ish right there. And then we started to see some light, and then it really kind of took off. I think the same thing is happening. Let's say 2022 is the peak, somewhere around there, right? It's been about 3 years. Maybe we're falling at the bottom. Maybe it's 4. But it's like a Titanic ship. Real estate takes so much time to typically turn and then turn again, right? And so you've got to have a strategy that gives you flexibility with timing. Okay. That being said, let's keep moving here. So we talked about some due diligence. We talked about some cash flow, tax flow, debt flow. What else about just the idea and the mindset of the passionate living through passive investing that you feel is in the book that could be very helpful for people to hear?
Yeah, well, the first is take immediate action. Whatever you learn from this podcast today, if you don't apply it within a day, much less likely that you're ever going to apply it. If not within a week, forget about it. So you want to take immediate action. And I like to say immediate and enthusiastic action. You want to make sure that whatever you start, whether it's I decide I am going to become a multifamily investor today, or I'm going to get six-pack abs, you want to tear into that goal like a tiger, so that when life comes on and your buddies want to go out and drink or whatever, that you are able to resist that. So take immediate and enthusiastic action. And the other is continuous improvement. So whatever you're doing, if you want to go, say, from single family to commercial real estate, etc., just look at it. Don't say, like, what do I need to learn to get there? Think of it as continuous improvement. Because, again, the game's going to change, and it's going to change again. Continuous qualitative improvement, too. Don't just think about, hey, I want to run a little faster today. You want to be running in a different way. Do something extra, high-intensity interval training, etc. If you look at actually how runners run, it's not just like, yeah, I'm going to try and run faster today. They do all kinds of things, like looking at their intensity. Some of them do low intensity. They break it up morning, afternoon. So the idea is look for qualitative improvements. You want quantum leaps in your life. not a little bit of quantitative improvement here and there.
Excellent. We're talking to George Roberts, everybody. You can get his book, Passionate Living Through Passive Investing, on Amazon. And he also has a podcast with the same name. And or go to robertscapitalenterprises.com. robertscapitalenterprises.com. Invest passively in real estate without the tenants, termites, and tantrums. Excellent. What question have I asked you so far, Robert, that you want to make sure we cover?
Oh, gosh. I swear I had something up.
It's okay. I can ask another question. It's all good.
Yeah, I'm sorry.
No, it's all good.
I don't have anything prepared at the moment.
So let's talk about deals that, you are actually investing now, or has it been kind of wait and see? Like, what is your appetite and or action that you're taking with, this marketplace right now?
Right. Well, I certainly see things are turning, certainly open to it, but, it takes time. So it's hard to say if we hit bottom. I mean, I check the stats every quarter and it looks like we kind of leveled off, but then actually we are still trailing down a little bit. I think that I wouldn't counsel people to wait, but again, things may continue to get better in terms of prices. So, definitely, I never stopped doing deals, but I slowed way down. And definitely looking at continuing and possibly accelerating in the future.
Okay. And I'm curious for you, if and when you've exited, have you done 1031s, or what's been your experience with that?
Yeah, so exiting from a syndication, not easy to do. Obviously, there are ways to do that. You can have direct ownership through various types of structures, but for me, unfortunately, I just had to go and grab the cash. So that's one of the great things about joint ventures. I actually do smaller deals as well. Love joint ventures, and when you do that, yes, you do have that direct ownership, and you don't have to go through any additional rigmarole, tenants in common, etc.
Right. Let's talk about that for a second. So I couldn't agree with you more too. So what's some of the general keys if you're looking at a joint venture partnership into a real estate opportunity that you found that you want to make sure that you have in yours and or people should have in theirs?
Well, probably what people overlook the most is the cultural fit. I mean, this is like a three-way, four-way marriage. So make sure that you guys get along. But again, in another sense, you're not actually getting married. So do a deal, see how it goes. You don't have to go too fast. Yeah.
Good. That's good. And then just figuring out equitable percentages. How do you come to that type of, who gets what percentage of the deal or how that works?
Right. So there's various ways to do that. For example, your underwriting spreadsheet may have some suggestions. But just remember what's different about your deal. For example, if there's a non-recourse loan, that's a lot bigger deal to sign on. So definitely towards the high end. How hard is it to raise capital? If you're newer, you might have to allocate that to somebody outside the team, more or less. So then maybe you have to allocate more to the capital raise. Obviously, you can't allocate only to capital raise. Want to make that clear. But considering that along with everything else that everyone is doing. So also look down the road, for example, here's one situation that I found interesting. So you have seller financing, but when it comes up for refinance, who's able to sign on the loan? So at that point, maybe you want to allocate something for that, again, considering what else is going to happen. And then also, how hard is the construction? So different ways to do that too. Is it an equity percentage? Or are we talking about, say, 10 to 20% off of the gross revenue?
Oh, that's such a good. It's such a good point. Yeah, because you might go into a deal just on the seller financing standpoint, right? And you get this, let's say a 3-year seller finance deal, and great, we closed it, but then 3 years is up, and you're like, okay, well, can we qualify, or who's going to do it? We're in a,
right.
Is the bank going to loan to all three of us, or how financeable are each of us? And I think there's like a 20% threshold for a lot of loans. Like if you're more than 20, if you're 20% or more, then they're going to want you to be on the debt, right? Is generally what I've heard. I don't know if you've heard this. So sometimes, make sure you're 19, right? And so all of a sudden, oh, no problem. Then we'll just finance that one person. But that's such a good point you bring up there. And so making sure that you have a plan for it and you have that in the partnership operating agreement that, hey, if and when this happens, so-and-so is taking responsibility to sign on the recourse loan.
Right, and then also the relative net worth, depending on your building, if it's trivial or maybe not trivial, and then who's really pulling the weight. So yes, you're right. You might all be signing on the loan, but who's really guaranteeing it? Well, here's another good one. If you are guaranteeing the loan, you can ask to be a partial guarantor, for example. A lot of people split it up, and as long as it's in your docs, you don't want to have joint and several, because then they're going to come after any and all of you, right? But if you write it up such that, hey, we each got, 2 million net worth or more, and, $4 million debt, and we want to be 50% guarantors, we don't want to have, any liability beyond $2 million.
Got it. So like basically writing into the loan docs, capping out your total, potential payout on the recourse versus so partial. Interesting. Yeah, never heard of that either. That's great. Any other tips for successful joint venture partnerships that you would recommend people think about?
Yeah, I mean, often it's a smaller team then, and make sure you have everything you need. Obviously, do you need construction, etc. I think that's one of the things that maybe makes the joint venture a little bit more challenging.
Yeah, I think defining those roles, right? Construction, investor relations, finding the deals, underwriting the deals, and then managing the deals if you can to complete it, and really defining those key roles that come together.
Yeah, one other thing you do is, have your docs set up. So, like, what if somebody doesn't fulfill their role or things change? What if you can't sign on that loan? What if you're not able to take part in asset management, etc.? Do you have a way, a mechanism of reallocating? Because usually that doesn't happen, and that's just how it is. But it's not a fun situation.
Okay. Yeah, makes sense. Very good. Excellent. We're out of time. You ready for lightning round?
All right, let's do it.
All right. Knowing what you know now, if you go back to your 20-year-old self, what's the one gold nugget? Make sure you tell yourself to do.
Well, I would just tell myself that everything's going to be okay. I worry too much, and it's going to be good. Just work hard.
Excellent. I love it. Question number 2, number 1 book you've recommended the most in the past year.
Oh gosh, I just love Dale Carnegie, How to Win Friends and Influence People. Great for business, great for life.
Love it. That's a great book. It's one of the best books. Question number 3, what are you most curious about right now?
I'm sorry, you say what am I most curious about? Yeah, sure. Always real estate data, always digging in, always taking a look at the construction. I've got a construction tracker on my YouTube channel. You can see how far ahead or behind we were during each construction cycle.
By the way, last year it was said that we're a 30-year low for first-time home buyers. Were you able to look into that data and any thoughts on that?
Yeah, there's a huge amount of pent-up demand. Certainly, we're going to see a lot of households created, and I think that we're a lot further behind in terms of how many houses we need. The only thing that's kind of working in our favor in terms of the housing crisis is that, well, a lot of people have left recently, either voluntarily or not. So apart from that, we're still going to be in this housing crisis a long time.
So what do you mean by left? I mean, they're just giving up about buying houses?
Well, no, I'm talking about deportations. So that's why I say.
Yeah.
But there's also been a lot of people that have just decided, hey, you know what? I don't have status. I'm leaving. So we have lost a lot of people.
Got it. Yep, makes sense. Next question. Number 1 way you're using AI.
Oh, working with HeyGen, and I love it. It's a lot of fun. Make your avatar and just have it do the heavy lifting for you. You just write a script, or hopefully you're having Claude or your assistant make the scripts.
Cool, love it.
Yeah.
And HeyGen versus Cloud. I mean, how do you determine what you're using?
Well, yeah. So HeyGen is really just for your avatar. So if I want to go and put out, say, a 60-second video, I don't want to deal with lighting. I don't want to deal with the cat walking across the screen, etc. It's perfect and makes things a whole lot easier. Claude is great for generating scripts. So really, I would say it's kind of a 1-2 punch. I use Claude these days a lot more than I'm using any other tool. So, yeah.
Okay, that's cool. Awesome. Thanks.
Stack them.
Stack them, baby. Yeah, sounds good. Next question. Number 1 leadership quote or theme that you strive to live by.
Yeah, I would say, sorry, oh God, it's my favorite one. Give me a second. So I would say that Gosh, it's a long day.
Let it all
So
out. It's all good.
I,
It can be a
I
theme.
shall.
It can be a
Yeah,
theme too. It doesn't have to be the
yeah,
exact
theme. Okay,
quote.
sorry. Let's
Yeah.
do this. I shall find a path. If there's no path, I shall blaze the trail.
Okay. Sweet. Love it.
So
Next
anyway,
question.
Hannibal, paraphrase.
Yeah, it's good. Last question. We'll wrap it up. After all your success, helping all the people you've helped, how do you best keep a mindset and practice of stewardship over ownership?
Yeah, so I think it's really just a total mindset shift. Again, it's not about stuff for me, and that helps a lot. So if I just realize that if I'm happy with what I've got, then I'm happy. I am as wealthy as I could possibly be.
Beautiful. George Roberts, it's been awesome having you on the show. Tons of wisdom today and lots of insight. I want to encourage you to keep using your enthusiasm and your curiosity to help people make great decisions with investing and get to a passive state. They can make a bigger impact and have more freedom from their family. And so just thank you for what you're doing. For our listeners who want to get in touch with you, one last time, what's the best place for them to find you?
Sure, you can find me at my website, www.robertscapitalenterprises.com. Whether you're looking at somebody to help you look at a deal, if you're an active investor, you want to invest passively, all those sorts of things you can do at my website. And there's also freebies.
Awesome. Thanks, George. I also want to thank all of our listeners for listening to another episode of the Build It to Billions podcast. We're also streaming on Capital Gains Tax Solutions podcast and YouTube channels. And I want to encourage you to continue this journey along with us to scale from millions to billions so we can give more all the way to help MVPs, the most vulnerable people. If you have a large exit coming up, we also have a service to be able to eliminate the need for the 1031 exchange for Bitcoin businesses, real estate, defer tax, and invest passively into investments or actively into your own deals. No timing restrictions. Just go to capitalgainstaxsolutions.com. That's capitalgainstaxsolutions.com. I'm Brett Swartz. He was George Roberts, and we appreciate you listening today. And we'll talk again soon. Bye now.